Welcome. My name's Lynn Gillette. I'm the president of the Silicon Valley chapter of AAII, and we have our tax program in November, and this will be extra exciting because of the changes. So welcome. A couple of just business things to address your questions. Please go to Q&A. Don't use chat, just use Q&A. Post your questions. We'll be feeding the questions in during natural breaks in the discussion. And so you won't have to worry about doing them later. You can just post your questions to us all. We have over 100 attendees, so the question is really the only viable way to do it. I'd like to give an invitation to anybody who'd like to join and assist those on the board. We could use additional volunteers in areas of publicity, finding speakers, web page management, video editing. If you're interested, just send a note to any of the board members or to myself on our Yahoo website, which is in all of the advertising. The recording will be available in about a week. We'll have members of the San Francisco chapter who have also been invited to join us. And after this introduction, the program will proceed. We'll do it in two segments, take a break in the middle. Should be able to answer all your questions we have in the past. Our speaker is Russell Barnett. He is an enrolled agent, that's an EA, and a certified tax strategist. The topic is 2025 tax changes for investors and year-end strategies. We're at least for me, I'm right in the middle of the year-end strategies. Russell Barnett will be reviewing changes to the tax landscape in 2025, including the big tax bill signed into law in July, as well as what investors should be considering to help them predict and minimize their tax burden as we close out the year. Russell, as I stated, is an enrolled agent and certified tax strategist with more than 20 years experience. He is CEO of the Silicon Valley Tax Coach in San Jose. He provides comprehensive tax and accounting compliance services for small businesses and individuals, as well as providing tax planning for business owners and investors to legally reduce the amount of money they pay in taxes. So I'll extend a warm welcome to Russell, and you have the podium.
Thank you. Welcome everyone to Death by PowerPoint for 2025. I apologize in advance. There's a lot of information to go over this time. And so I tried my best to put a lot of important information on the slides so that you can refer to them later, which means that some of them are quite dense in terms of text. I will do my best to explain everything. There's a lot of changes for 2025 and that are also taking effect next year in 2026 to be aware of. So please put your questions into the Q&A, not into the chat. And as there are breaks throughout the presentation, natural pauses, the questions will be addressed. I prefer to try and keep them kind of in the flow of things so that the question and answer can be as relevant as possible to what we're talking about at the moment. So thanks for joining me, and let's get started. So just a little bit about me. As Lynn had mentioned, I've been an enrolled agent since 2005, so a little over 20 years. I've been doing taxes since 2003. And a certified tax strategist and certified real estate tax strategist. We try our best to find ways to save our clients money. We've saved them millions of dollars since 2018 when I started being a little bit more proactive in my approach rather than just filing tax returns. We do that as well, of course, but that is basically the long and short of things. So I will move on. So just a quick summary. We're going to, the introduction to general tax concepts. If you watched my presentation last year, you'll find these a little familiar. I largely reused some of my slides because what was relevant and needed explanation back then is still mostly the same this year. And then, of course, the 2025 tax law changes is going to be all new. 2026 tax law changes are going to be all new because these things didn't exist when we talked last year. And then year-end tax considerations is how we'll close things out. So just a quick overview of how taxes work. I believe that most of you are pretty sophisticated, but so I won't spend a lot of time on this. We have different types of income when it comes to taxation. Of ordinary income, which is your W-2 income, short-term capital gains, non-qualified dividends, interest, business income, etc., that are just taxed at ordinary income tax rates. Investment income is a subset of that, and it can include long-term capital gains as well. It is relevant for calculating certain taxes and certain deductions, right? Capital gain or loss, either short-term or long-term. Long-term receives a more favorable tax treatment in most situations, in that it has a maximum tax rate of either 0, 15, or 20%, depending on how much income you have overall. Passive income is income that you get from, well, this particular concept is regarding business income, including rentals. It is a classification of income for businesses that you are invested in but not running, or rental real estate. Rental real estate is by statute going to be classified as passive, regardless of whether you're running it or not. So self-employment income is income from a business that you do run, that's not through like a corporation, basically, because then you'd be an employee. And qualified business income is income that's passed through from business activities, including rental properties, partnerships, and S corporations. So types of taxes, income tax is pretty self-explanatory. Self-employment tax is your Social Security and Medicare that gets assessed on self-employment income. It is at 15.3% until you reach the FICA maximum, which is Social Security is 12.6% and Medicare is 2.9%. So net investment income tax applies to that investment income that we mentioned on the other side. Alternative minimum tax applies. It hasn't been as much of an issue in recent years since 2018's Tax Cuts and Jobs Act. It may become a little bit more relevant now that some of the changes have been made this year. So alternative minimum tax is a kind of a parallel tax calculation that takes your taxable income from your tax return, makes some adjustments to it to account for some things that are treated a little bit differently, and then assesses a flat 26 or 28% tax on that taxable income and compares that to your normal income tax. That's unfortunately about as simple as I can make it. It is kind of a arcane concept. So Medicare surtax would be applying to earned income above $200,000 per year on a single return, or $250,000 a year on your on a joint return. So that is the additional 0.9% Medicare that gets withheld from your paycheck if it ever goes above $200,000, or adds to your self-employment tax if you are self-employed. So, and then credit repayments can be, the EV credits, the electric vehicle credits, can sometimes need to be repaid if you took them in advance and then find out you don't qualify, or the vehicle doesn't qualify. Other than that, it largely comes to the Affordable Care Act health insurance credits. Most other credits aren't paid in advance or taken in advance, and therefore they just get either taken or not on the return, and so repayment isn't generally an issue for those. And then mental health services tax is a special tax for Californians who have a taxable income over $1 million per year, or per return, I should say. And that is 1% of the taxable income above $1 million. So,
There is a withholding question. Do you want it now?
yes, go ahead.
If one takes a large capital stock gain in November and December, how should the Fed and state taxes be paid? Does it matter if one has already had more than 110% of last year's taxes withheld?
Maybe. We actually talk about underpayment penalties later in the slide more towards the end. But if your income's under $1 million, then no. If your income is over $1 million for the year, then California doesn't observe the 110% threshold. So we'll go over that later. So you can make an estimated payment to make up the difference between what you're supposed to pay and what you did to avoid underpayment penalties. We'll talk about that later in the presentation. So this is pretty much the same as last year. I always like to stress this because I have this conversation, I don't know, dozens of times every year with different people, right? We want to make sure that it's understood that tax rates are marginal, not retroactive, meaning that when your income goes into, crosses a threshold into a new bracket, only the income in that threshold, in that bracket, that range of income is subject to that new rate, right? So it is impossible to take home less money or have less money just because you moved up a tax bracket, right? So just wanted to kind of clear that, or make that clear rather. And at the bottom is the note saying you will always have more money after paying taxes on your income than if you don't have income, even if it doesn't always feel that way. And the same logic applies to deductions, business losses, or anything else, right? I have this conversation a lot as a tax strategist. People come to me and they want to find ways to, they want to make deductions and create deductions and credits and lower their tax bill, which is completely understandable, but don't let the tax tail wag the dog. This is my dog Nimona. So she is here to remind us that, because of the way that math works, in California, we pay a lot of taxes here. There's no questioning that. But the maximum rate you can generally pay is around 50%, right? That's 37% federal and 13.3% to California. So that's, 50.3%, meaning that at the very worst, you will always have 49.7% more money in your pocket than you did before you earned that income, even if you're paying taxes at the very highest rate. Again, even if it doesn't always feel that way. So, which is valid. So, um, you know, I get a lot of people coming to me every year, and even my own clients, and they talk to me, and they're very worried about tax brackets, and I always just tell them like, hey, to get your income when it's time to make the income, right? And when you're making an investment decision, um, you know the tax rate you're going to pay on that investment should never dictate when you exit it, right? Because investors are very savvy people and they're always looking at what's the best return on their money. And even if they end up paying an extra 5% of taxes, they cash it in this year or next year, or whatever the marginal difference is, if you decide that it's a good time to exit that investment, then if you wait for a better tax um, rate, then the value of your investment can drop. Um, and if we look at specifically a Roth conversion strategy, right? When people are converting income or pre-tax retirement accounts to post-tax, you have to pay the tax on it, right? And there's always the question of do it all at once or do it over time. And if you look at the time value of money, and we hope that your account will continue to grow, you're going to end up converting and therefore paying tax on more money if you do it over time than if you just do it all at once. Even if you look at tax brackets, and first of all, if you're doing a Roth conversion strategy, tax brackets are probably, you're pretty much up there already, right? Most people are not going to, unless they're, other than just for a backdoor Roth, contribution. If you're doing a larger conversion, then you're most likely going to generate a fairly substantial amount of income. And so, if you look at, if you have $100,000 today and you were looking at converting it and paying tax on it, or you want to do, $25,000 over 4 years, you'll probably end up, I don't do the math off in my head, but you might end up converting and paying tax on 110 or $120,000 instead of $100,000. And there are very real considerations about that with, viability or feasibility and affordability of paying all of the tax that on that conversion. But if you're worrying about trying to take advantage of tax brackets, then I would encourage you to look at that instead, and say, how much am I actually going to pay tax? Because the implication is also that, if your account had continued to grow, assuming you invested it the same way in your Roth IRA, then that 10 or 20 or whatever $1,000 that you're paying tax on extra for conversion would have been in your Roth account and tax free. And so just again, something to consider and think about, and not worry as much about tax brackets as most people do, because the marginal difference is usually not that large. And again, the value of your investment will change over time, which also needs to be considered. So a refresher on some of the Secure Act and Secure 2.0 provisions that are now in effect, just to do a quick overview. There are no requirement distributions for Roth 401ks. That was ambiguous before. Emergency distributions are allowed from an IRA without early withdrawal penalties up to $1,000 every 3 years. It's not a huge amount, but it is something that people can tap if needed. 529 to Roth IRA conversion rollovers are allowed within certain limits, which we'll go over, I think, in the next slide. And required minimum distributions are now required starting at age 73. They used to be 70 and a half. But when they made that change, they did not change the age for qualified charitable distributions or QCDs. Those are still allowed starting at age 70 and a half. And qualified charitable distributions are distributions from your IRA that are directly to a charity. They do not count as taxable income, and you do not get a deduction for the donation because you're not recognizing that income, but it does count towards your required minimum distribution for the year, right? And so for some people that are may not be itemizing anymore as they are in retirement by the time you're 70 and a half, hopefully, a lot of people have their mortgages paid down, and with the SALT cap at, well, up until now $10,000, but we'll talk about that later. A lot of people, and plus they've increased the standard deduction in standard deduction, in recent years. So some people may not be itemizing, and this is a way for them to still make tax-free donations to charity. And there's also a change coming to charitable deductions in the coming years, which we'll talk about in a bit. So it is an important strategy to be able to make tax-free donations even if you don't itemize and also account towards your required minimum distribution, so your taxable income from the IRA will be lower. So
Two questions.
sure.
If you take a QCD, does that income still apply to IRMA, or would it reduce your income for IRMA?
I believe IRMA, which is not my strongest area of expertise, looks at your adjusted gross income, and a QCD is not part of your adjusted gross income, so it should not be factored. But that could be incorrect. So, but I believe they look at the adjusted gross income for IRMA purposes, and the QCD would not be part of that, so it would be excluded if that's the case.
How to target IRA to Roth IRA based on your income bracket? Is there a good strategy?
So we just went over that in the last slide. No, I don't really think so. I think that the overall financial goals that you're trying to achieve for your retirement and assets are far more determinative than your tax bracket. I mean, nobody likes paying more taxes, and everybody would rather pay less than more, and that's understandable and perfectly valid. But I tend to view tax bracket strategy or strategizing as overblown because there are so many other factors that go into whether and how much and how and when rather to make a Roth conversion that are not tax related. So
This question you may be answering later. Are capital gain rates also marginal?
no, wait, sorry. That's a weird question to answer. I'm sorry, because the way that taxes are calculated is that they take your ordinary income and they calculate the tax on that, and then they take the maximum tax rate on your capital gain, your long-term capital gain and qualified dividends, and add it on top of that, right? And so it's kind of separate from the tax bracket conversation. Other than that, once you move out of the 12% bracket, you're now going from 0 to 15% on long-term capital gains. And then once you get into the 37% tax bracket, you go from 15 to 20%. So from that perspective, yes, they are kind of marginal because the income that falls within those lower maximums will be, hit that, but then they're kind of also not because they're not part of your normal taxable income calculation. So that was probably not the clearest answer, but I think it's the clearest I can provide. If there are still questions about that, please, put them in the Q&A. So.
What is a qualified business income, QBI?
So qualified business income is it's a subtype of income from a pass-through business activity, such as a rental property on Schedule E, a sole proprietorship on Schedule C, or a K1 from a partnership or an S corporation that carries out a business activity. There are also income that comes from those K1s, such as interest, dividends, capital gains, et cetera, that are not QBI. So it is a business activity. And it allows you to take a deduction against your federally taxable income that's separate from your itemized or standard deduction. Trying to distill it down, sorry. That's generally going to be like around 20% of your qualified business income figure. There are some exceptions to that, and there are also a class of dividend distributions from funds and other investments that invest in real estate, where the dividends can also be considered QBI. separately from any other business activities that you're having. So
And then the last one is QCD part of modified adjusted gross income.
no, because it's not part of your no,
I,
it's not. As far as I'm aware, it's not. Sorry, the
okay, and the
modified is what it was like. I was about to say, no, it's not part of your income, but then the modified, I had to think for a second. I don't believe it is. So it's not one of the
website.
when it goes into your modified AGI, they're typically adding back things like municipal bond interest that's not taxable and stuff like that. So, and sometimes IRA contributions, and there may be some other adjustments. That's something I do manually very often, or I have to worry about. That usually just gets taken care of by the prep software, and it's not relevant that much to my practice. So, right.
Would a 50-year-old be eligible to do a Roth conversion from an IRA more than a 5-year-old without any penalties? There's no penalties on a conversion, right?
There's no penalties on a conversion, and there are no age limits or income limits on converting to a Roth IRA. I believe the 5-year-old comment is about usually um, distributions from a Roth IRA are not taxable to the extent of what you put in. And also, if you take out more than you put in other words, the growth or income on the account, it's not taxable if you've had the account for at least 5 years, or it's been at least 5 years since you made your first Roth IRA conversion or contribution ever, um, and are over 59 and a half. So, and then another thing could be that they talk about that if you convert from a pre-tax to a post-tax account, then you can't access those, even though you've paid tax on them when you do the conversion, you can't access those amounts penalty free for 5 years. But you are, yeah, but if you're over 59 and a half, it's kind of moot. So I think it's basically to prevent people from trying to avoid early withdrawal penalties by converting their pre-tax to post-tax and then taking the money out, because when you take out money from a Roth IRA, it's not taxable or penalized to the extent you put the money in, right? And then also the conversion itself is not penalized. So I think that's just trying to avoid that end run around. So
Okay, that's finally the last question that came in.
sure, no problem. Keep them coming. So just a reminder that as of 2024, it is possible to roll over funds from a 529 to a Roth IRA with the following stipulations. It is limited, right? The 529 must have been established at least 15 years prior to the rollover distributions. It's not actually clear whether the beneficiary had to have been the beneficiary for 15 years before the rollover. I believe the statute just says that the account has to have been in existence for at least 15 years. The total amount that can be rolled over is $35,000 per beneficiary, right? And it's also limited to the amount of allowed Roth contribution for each year. And so, and then it counts towards their contribution limit. So basically, it allows you to take excess funds from a 529 after they're done with college and don't need that money anymore. It allows them to use that to fund some of their Roth contributions for, um, and use up that money without having to withdraw it and pay income and penalties on the growth since the account was established. So this is still new. I haven't seen anyone do it yet in my practice, but it is something to kind of keep in mind. Oftentimes, people, they don't know how much money their children or grandchildren are going to need for college, and so they fund it generously in their early life, and then they also don't know what it's going to grow to, right? And so sometimes there is money left over in the account after they're done with their degree programs or done with school, and then and they could also, of course, qualify for fellowships and scholarships and grants and stuff like that bring down the cost of their tuition. So this is just an option. It allows you to take some of the money left over for certain people and put it into a Roth IRA without having to pay tax and penalty on the growth. So, and then another just quick reminder from last year is that in 2024, the IRS finally issued final regulations requiring that that an inherited IRA that it was subject to required minimum distributions in the decedent's life must also take required minimum distributions and also must liquidate the account within 10 years of inheritance before it was kind of ambiguous, and a lot of people were saying, oh no, as long as you liquidate it within 10 years, you don't need to make an RMD. The IRS position for a long time had been that you do, but they weren't enforcing it. They are now enforcing that. And so you will be required, subject to the RMD penalty if you do not take the required minimum distribution that you're required to, which is why it's called required. And that's 50% of what you didn't take out. So it's quite expensive. So a non-spouse IRA beneficiary must generally liquidate the IRA within 10 years and are also subject to RMD requirements if the decedent was of age that required minimum distributions. So this is not new. I told you about it last year. I'm just kind of making sure everybody knows about it. So on to the main part of our presentation, the new stuff, right? So there was a big tax bill that everyone probably heard about. I can't imagine anyone here didn't hear about it. It was all anyone talked about for many months leading up to it. And after, there was a lot of confusion about it, or is a lot of confusion because of a lot of the provisions that were discussed and proposed didn't make it in the final bill. And there's also the government using misleading language to describe what did pass, in my opinion. So we're going to talk about those changes and try and make sure that you understand what actually made it into the final bill and how they actually work, at least generally speaking. So these are the things that were not passed in 2025. No tax on tips, no tax on overtime, no tax on Social Security, despite the email the Social Security Administration sent you, no tax on car loan interest, right? There are, however, some new temporary deductions that exempt limited amounts of qualifying income from federal income tax if your income falls within the thresholds that were set, right? So this is what the government is calling it. Even in some of their official communications, but that is not what they actually passed. And so this is part of what's causing a lot of the confusion about what actually passed and how things work. So my goal is to try and explain how they actually work so that you have a better understanding and they're not don't misunderstand how it is based on the rhetoric that's being propagated. I don't know. So just some quick updates on your limits for 2025. Standard deduction is at $15,750 for single filers, and it goes on. I'm not going to read them out. Your qualified charitable distribution limit is increased to $108,000 for 2025, up to $105,000 in 2024, meaning the qualified charitable distributions that we discussed before, up to $108,000 of those can be counted towards your required minimum distribution limit. There is nothing saying that you can't gift more than what your RMD is. It will just continue to be money out of your pre-tax account that you'll never have to pay tax on. Going to a charity of your choice, and then you'll also have your RMD, satisfied without having to pay tax on it. So the annual gift limit increased from $18,000 to $19,000 per person per tax year, or taxpayer per year, right? Meaning that we have an inheritance tax in the United States. It's an excise tax on the transfer of wealth from a decedent, a person who is deceased, to their beneficiaries or heirs. And currently that is at around $15 million per person exempt. And the gift tax is a kind of a related tax that prevents or aims to prevent wealthy people from avoiding that estate tax by giving away all of their assets during their lifetime. And so if you give up to $19,000 to a single person per year, you do not have to worry about the gift tax. If you go above that, then it starts to reduce your lifetime exemption. That again is about $15 million right now. It's not something that most people encounter regularly, but it's something to just kind of be aware of. So a married couple can split gifts and give up to $38,000 to a single person if that person is married. Like if you're trying to give money to, most commonly I run into, hey, we want to give our kids some money to put down on a house or something like that, right? Then you can give up to twice that, right? So $76,000 for both spouses to give to both spouses, right? And above that, you'll have to file a gift tax return and not owe any tax unless you've already used up all of your lifetime exemption. So, and if you're in that situation, you have an advisor, and I'm already aware of that. So, 401k limits are up to $23,500 from 23 and 24. And Roth IRA contribution limits remains at $1,000 or $7,000 or the amount of earned income, whichever is lower, right? So people that are no longer working and have no earned income are not eligible to make an IRA contribution. Other people can contribute up to $7,000 or however much they earned, whichever is lower. So
Russell, I have a question.
sure.
If you give a gift to a grandson or granddaughter of $25,000, which would be 6,000 over the 19, what happens to the $6,000? How is that handled?
So if the person making the gift is married, then you don't have a problem because you can just split it and treat it as if you paid $12,000, gifted $12,500 each. If you're not married or not splitting gifts, then the other $6,000 would be reported on a gift tax return, and it reduce your lifetime exemption of approximately $15 million. So there would not be any tax due, but there would be, or technically be a requirement to file a gift tax return to report that, so the IRS would know that that you were using part of your lifetime exemption. Yeah. Another thing to mention real quick is that if you make a payment directly to a school or medical provider, that does not count as part of that $19,000 threat or limit, right? So if someone has tuition to pay and you want to gift money that, if you pay it directly to the school rather than giving it to them or to their parent, then that will not count as part of that $19,000. And the same would apply if you're paying a medical bill for someone. If you pay directly to the provider rather than giving them the money to pay to the provider, then it also does not count against that $19,000 per year per person.
One relevant question. The last year he was allowed to contribute 8,000 to an IRA. Now the max is 7,000. I assume he's over 50 probably.
There is $1,000 catch up for people that are over 50 years old. I did not put on the slide or mention. Thanks for bringing that up, and I'm sorry for overlooking that. So, yeah. So the EV credit up until September 30th of this year is the same as last year, right? And so most of this information is the same as the slide from last year, right? The caveat now, or the change, is that the vehicle must have been delivered by September 30th of 2025 to qualify for the credit, or you must have been under contract for a specific vehicle by a binding contract for a specific vehicle by September 30th, 2025 to qualify. That means that, this car, this configuration, this VIN is what you are buying and you can't get out of it. It just happens to not have been delivered before September 30th, right? So having a nebulous reservation that's not for a specific vehicle at some future point, is not going to qualify. And yes, I actually did see a client get audited on this when they passed the infrastructure bill, a couple of years ago and created these rules. I had a client who had accepted a BMW, or had ordered a BMW, which doesn't qualify under the new rules because it wasn't built in the United States, but did qualify for the prior rules. It was disallowed because he had only a kind of an informal arrangement or agreement that at some point they would get a vehicle, and that he would be entitled to purchase it or have it reserved, but not a specific vehicle. And so the other thing to be aware of is that when you buy something, when this credit existed, the dealer was required to, if you bought a qualifying vehicle, was required to report to the IRS who bought it and the VIN and the price, et cetera, and the date it was delivered, and only that person can claim that credit. So if a parent is buying a qualifying plug-in electric vehicle for their child, then the parent, but the car's under the child's name, which is what I saw a couple times in my practice, then the parent would unfortunately not qualify for the credit, even if they were the one paying for it. So I don't think I need to spend a whole lot of time on this, especially since this isn't relevant anymore, unfortunately. So you can't go out and buy an EV and get a credit right now, at least unless they change the rules again. So I'm just going to move on. Are there any questions?
Yes, there are questions.
Sure.
Does the recipient of the gift pay taxes on it? And that's
No.
probably not clear. If you give something with capital gains, then there could be.
Well, I mean, if they sell it, okay, so when you gift something that's appreciated, then they're going to generally keep your basis, meaning that when they sell it, they will have a gain or loss based on the difference between the sale price and the gifter's basis, right? So yes, I guess, but there's not a tax on the actual gift, the transfer of the securities, property, or whatever it is. There's not an income tax on that transfer. Yeah,
And
I think that's
okay, can a U.S. tax person gift to a foreign non-U.S. parent? And can that be a MTM PFIC owned by the U.S. person? I have no idea what those initials mean.
the PFIC is so a foreign investment company, basically. So
Mhm.
um, as far as I know, there's not a restriction on gifting money to a foreign person. It still would count against your the U.S. resident or citizen's lifetime exemption, and be subject to that. But international matters are actually quite complex, and I'm always wary of what I don't know that I don't know. And so that might be something that is better addressed to someone who's more has more experience with foreign tax issues. So
If the gift is 19,000 cash, does the recipient have to pay taxes on it?
no,
Does it add? No. And it doesn't add to the recipient's tax basis.
no, nor does it reduce yours, which is the other question I usually get with that one. So.
Is the 529 allowable 35K transfer per year or only once?
Talking about the Roth IRA, it's lifetime. $35,000 is the limit of the lifetime. The annual limit is whatever the recipient's Roth IRA eligible contribution limit is. So,
Okay.
if they have higher income and don't qualify to make a Roth IRA contribution directly, then you would not be able to transfer money from the 529 to the Roth IRA for that person in that year. So,
Are solar credits limited based on income?
no,
Okay.
they're not refundable. However, I mean, they don't bring your tax below zero. They do carry over.
Okay.
Actually, I think I meant to, and I did not actually create a slide. I'm sorry. The residential energy credits, including the solar credit and energy efficiency credits for the home, have also been revoked as part of the big bill. But the completion of those has to be done by the end of the year. It's not limited to September 30th like the cars are. So if you have an energy efficiency improvement product, insulation, new water heater, new HVAC, solar panels, windows and doors, etc., then the normal energy credits will apply as long as you are done with the project. It's completed by December 31st. There's been some chatter in the prepare community of people being told that, oh, if you pay the amount up front or put it into an escrow account, even if it's not done by the end of the year, you still get credit for it. That is false. I've not seen anything that suggests that is true. Always be wary of whatever tax advice salespeople give you. So
One is above modified AGI and contributes to a Roth IRA account directly. Is it considered excess contribution? How can this be taken care of for 2019 and 2020, since it's been a few years? So they may have a long-term problem.
yes, and generally speaking, I would say just resolve it in the current year. And I've never seen the IRS actually go back in and enforce a penalty on that. It's better to take it out now that you know about that you made eligible contributions. Technically, you're supposed to pay 6% per year of the amount that was excess. But I've never seen the IRS enforce that. Doesn't mean they can't or won't or shouldn't. It just means that if you take the money out as soon as you're aware of the error and pay tax on it, then or the tax on the excess over what you put in anyways, then you may not have a problem. So otherwise you'd have to, honestly, I don't even know what and so the IRS can't assess additional tax on a filed return after 3 years, 3 years after it's due, generally speaking. So for 1920 and 21, they couldn't go back and make a 6% assessment, even if the taxpayer tried to send them money, they would return it, or they should return it, saying we can't collect this from you. And then for 22, 3, and 4, then technically they could. So
Okay, thank you.
there's been a permanent increase to the child tax credit effective in 2025 and forward. This is important to note because very few of the new tax laws relatively few of the new changes are permanent in the big bill. There were some permanent extensions of previously temporary things from the Tax Cuts and Jobs Act. But so it's been increased to $2,200 per year for qualifying dependents age 17 or younger by the end of the tax year, meaning that if your child or dependent turns 17 during the year, that means they'll no longer be eligible for this $2,200 credit, right? The refundable portion, meaning the part of it that can bring your tax below zero, has been increased to $1,400 per year. And both of these amounts have been indexed for inflation going forward, which is not always the case. So it's nice that they did that. Means that they won't have to separately pass another tax bill in order in the future to make it to be indexed or catch up to the current expenses. So the maximum credit is reduced for taxpayers with more than $200,000 of income or $400,000 for a joint return. Eventually goes down to zero. And those income thresholds, as far as I know, have not been indexed for inflation. So it sounds like a lot of money now. It may not in 10 years. So, and then the one other change is that the qualifying dependent and taxpayer and or spouse must have a valid social security number in order to claim this credit. Means that at least one of the filers, if you're filing a joint return, has to have a social security number, and the child or dependent has to also have a social security number, or else dependents that don't fall within these boundaries, either over 17, don't have a social security number, or the parents don't have a social security number, get a $500 other dependent credit instead of the $2,200. So yeah, that's the note at the bottom. Depends without a social security number or who over 17 may qualify for a $500 other dependent tax credit. So, or dependents that aren't your children. So parents or whoever else you're supporting for tax purposes. So here is the new deduction against tip income that everyone's talking about. And so you'll notice on the right side, I have a little meme that says you can't just say you work for tips. That was the joke. At least I hope it was a joke. That was being talked about a lot after the bill was passed or during the time when it was being debated. You can't just say that you work for tips and therefore none of it's taxable, right? Because first of all, there is no tax on tips bill or law. There is an annual $25,000 limit or amount of income from tips that can be excluded from federally taxable income. The maximum deduction is reduced by 10% of income over $150,000 per year or $300,000 for a joint return. One thing to be aware of is on the $300,000 joint return limit, doesn't matter who earned the money. So it's not $25,000 per spouse, it's $25,000 per return, right? And same thing for, yeah. And then only tips qualify. A tip is an amount that a customer can choose to give or not. It's not mandated by the service provider. It is not, it has to be discretionary and the amount has to be up to the customer. So a mandatory service fee that applies to all purchases, not a tip. Last weekend, I was having dinner at a restaurant and there was a sign there was a note on the sign on the menu. It said all menu items are assessed an 18% service fee. Those are not tips. And unfortunately, those will not qualify for the employees to exclude from their income when they go to file their tax return. I can only hope that they're aware of that anyways. Otherwise, it'll be a unpleasant surprise when they go to file their return. So the tip must be reported on a W-2 1099 non-employee compensation or NEC, or that's supposed to be 1099-K. I'm sorry for the typo. So a 1099-K reports payment processing for merchant service providers, PayPal, Venmo. It's also Uber and Lyft and DoorDash, et cetera, tend to report their the fees that their drivers earn on a 1099-K. As of right now, there's not been any exception for tips that were earned in a legitimate business. Like let's say you drove Uber but made less than $600. It's not reported on a 1099-K. Then it's not technically the tip is not excludable, unfortunately. So, or any other business, if you earn money and receive a tip, then if it's not on a 1099-K because you're under the threshold or because the business didn't issue a 1099, then as of right now, then you're not allowed to exclude it. So, and we're just assuming that everyone is reporting all of their income that's not reported on a 1099 anyways, and therefore would be wanting to exclude this. So if you're married, you must file a joint return in order to claim this deduction. In other words, if you're not in a community property like California, and are thinking, oh, well, our overall income is over $300,000, but one spouse only earned $50,000 and had tips on there, we're going to file separately so that they will fall below that threshold. That doesn't work. So they do have a provision that specifically says you must file jointly if you are married to claim this deduction. If you file separately, you do not get the deduction, even if your income is below the threshold. So, and then the taxpayer or spouse must include a valid Social Security number in order to claim this deduction. So, and importantly, on the other side, this deduction only applies to professions that traditionally receive tips prior to the passage of the bill. So we're talking about personal service providers generally and hospitality. I was not able to suddenly convert to only accepting tips for tax preparation and therefore being eligible for this deduction. I wouldn't be able to dictate the price anyways, and that wouldn't work for me regardless. But if you're not part of the professions that would traditionally receive tips, then this deduction is not available for you, even if you do receive a tip. So
A question that a little strange. Okay, large mandatory service fees don't apply, but tips for sex workers, entertainers, and Lyft drivers do qualify?
those are all professions, as far as I know, that traditionally receive tips. And so as long as the tip is reported as part of their compensation on their tax form, I would say yes.
There were a couple questions regarding gifts of stock. The holding period also transfers when you gift stock?
Correct. Yes. It's like the person receiving the stock or appreciated property steps into your shoes for tax purposes. Now there is a little bit of a quirk that says if they sell it at a gain, then that's true. If they sell it at a loss, then they calculate the loss based on the value of the property when it was gifted. That almost never actually comes up though, so I'm only kind of mentioning it in passing. So most of the time, if someone gifts appreciated stock, it's because they want the other person to sell it and pay tax at their rate instead of whoever's making the gift. And so there would be a gain. So this is one of the big new ones that there's going to be a lot of. And then the other thing is that the W-2 and other forms will be modified for 2026 and going forward to specially list the tip and later on overtime that we'll talk about in a little bit amounts, but those are not going to be in effect for 2025. So some payment processors or providers are going to still put it out in like box 14 of the W-2, whatever. But if you don't have that, then well, I think it goes on, and on the overtime slide, we talk about that you're allowed to use a reasonable method to be defined by the Secretary of the Treasury, which is as far as I know, not happened yet, to determine the amount. I imagine we would look at pay stubs and say, hey, on the pay stub, it says that your overtime was this much or your tips were this much, and go with that. So,
Okay, I'll leave the others were regarding Secure Act 2022 that said they could go back any time for Infinity for the Roth 6% penalty.
I wasn't aware of that. Thanks for bringing that to my attention. So, so I guess then you would have that problem back to 2019. So I generally didn't know that. So thank you for bringing it to my attention. So,
I don't know if it's true. It's just posted as
it
a question.
sounds plausible to me. The government will usually try and find a way to make sure that they have the upper hand when you owe them money. So,
Okay, thank you.
there's been a temporary increase to the state and local tax or SALT deduction limit. Since 2018, that's been capped at a flat $10,000. Almost everybody in California that itemizes is already well aware of this because it's been a pain point for them. Because, well, I live in Silicon Valley, so you could safely say that most people pay more than $10,000 in property tax alone. And then that's on top of the income taxes we pay to California, right, or any other state as well. So there's been a temporary increase for 25 through 29 for the SALT deduction limit to $40,000 per year. So now instead of 10, you're capped at 40. And but for returns with adjusting gross income over $500,000, it's reduced back down to $10,000 ratably. And once you hit $600,000 or higher, it's $10,000. So this does exist for people who itemize and spend more than $10,000 per year in state and local taxes for the next 4 years. So, and that does start in 2025. So And if you file separately, that limit is halved. It's just like before it was 5,000. Now it's 20,000 with the same 50% of the income limits, et cetera. So. So similar to the tips, there's a deduction against overtime income. The thing to be mindful of is that, again, there's no tax on overtime provision of the big bill. What they did is they exempted up to $12,500 of the premium portion of your overtime, meaning that if you are paid time and a half, then only the half is eligible for this deduction, not the time and a half, right? So it's not that you don't pay any tax on your overtime, it's that you don't pay, you're able to deduct a certain amount if your income qualifies of the premium portion of your overtime. So, and again, there's not in 2026, the W-2 forms will be modified to reflect to be able to list this amount. As of right now, there is not for 25. Most payroll processors, I think, are starting to flag it. I know for like ADP, which is the largest payroll processor in the country, as far as I know, then they're listing the premium portion on the pay stub separately. So they'll say like, OT, and it'll be the normal hourly rate, and they'll say OT premium, and it'll have the additional 0.5 or 2 or 1x if you're in 2x overtime. And then I expect that amount will be also listed in box 14 of their W-2, so it'll be easily identifiable. As with the tips, the Secretary of Treasury is saying that it's supposed to establish a reasonable method to determine overtime if it's not on the W-2 for 25. I can't imagine that's going to be anything other than looking at a pay stub that will have that information on there. So again, $12,500 for a single return, or $25,000 for a married filing joint return. As far as I know, doesn't matter which spouse on a married return earned the overtime. $25,000 is the maximum. It's reduced for tax returns with income over $150,000 or $300,000 for joint returns. I already mentioned that only the premium portion of the overtime pay qualifies, and that the forms will be modified starting in 2026. So, as with the tips deduction, married taxpayers must file jointly to claim this deduction. There must be a valid Social Security number for at least one of the taxpayers or their spouse if you're filing a joint return. And which I already mentioned, which spouse earns the overtime is not important. And on this one, only income reported on a W-2 qualifies. So if you are working as a contractor and happen to also qualify somehow for overtime, then you would not be eligible for this. On the tip side, you would be up to the amount of profit that the business shows. So, and then, oh, and then one thing to understand that's important is that the tip and overtime deductions we've been discussing are not itemized deductions, and they do not reduce adjusted gross income, but do reduce federally taxable income. So we've talked a couple times about, hey, does this qualify for, so like, it's not going to reduce your income for IRMA, right? Or when it comes to calculating deductible donations or medical expenses, or can you contribute to an IRA, or how much of your Social Security is taxable, all that other stuff, right? So it's not going to reduce the adjusted gross income or modify adjusted gross income, but it is going to reduce your federally taxable income. So it's going to be calculated or treated similar to the QBI deduction that we've had for many years now. So, yeah, which means that if you don't itemize, you still get this deduction if you qualify and have qualifying income. And if you do itemize, you still get it on top of that. So, are there any questions?
Yes, there's a couple, but not directly. Why does a parent not pay tuition directly to a college to qualify for the 19K gift then? I'm assuming
Most do.
most do,
I
and
mean, most do for logistical reasons, not necessarily because they understand that there's a gift tax issue potentially. Um, I would think that that would be more applicable to like grandparents or other family members that are contributing towards tuition costs. They might traditionally give the money to the child, or to the student rather, or to the parent to make the payment. I imagine that most parents would already be directly paying just because that's how it works, right? So.
um, HSA distribution or rebalance are taxable in CA. Are losses inside an HSA due to rebalance allowed to be offset against gains in later years?
California doesn't treat HSAs as anything other than a normal investment account. So I don't see any reason why a loss inside of it would not be deductible in the year that it was incurred within the normal limits of capital gain losses. So I don't know that I've ever addressed that question specifically, but I don't see any reason why I'd be treated any differently than any other, um, brokerage account loss.
What investment would you recommend so I could lower my AGI, oil and gas? I don't,
Sure, that's a great way to lose money and lower your AGI.
okay,
I mean,
that's
there are profitable oil and gas investments, but I've not seen any of them in my clientele. They get the we talked earlier about letting the tax tail wag the dog. They make an investment because they want that sexy deduction in the beginning, not really understanding that they're just deducting their own money that they just gave to the partnership after tax that they've already paid on it, and then they have this investment that they can't get rid of. So there are definitely people that are better at investing, I'm sure, that know how to do this. But yeah, so reducing your income is going to leave you with less income. That was the whole point of don't let the tax tail wag the dog. I'm sorry, going to leave you with less wealth, right? Because you're going to say, okay, I'm low, I'm going to generate a deduction of $100,000. You're going to save at most $50,300 in taxes and still be out money, right? So um I'm not an advocate of reducing income uh, unless it's an investment that there's another reason to make, right? So certainly there are ways that you can invest that are more tax efficient if the strategy or investment makes sense aside from the tax considerations. And then sometimes you can get a benefit from those, but there has to be a good investment underlying it. Otherwise, uh, it's not going to come out in your favor.
There's two related questions that just came in. Would you say tax tail wagging the dog applies to buying a second house to rent out? And how about buying a house as a short-term rental home?
The first one, maybe. The second one, probably. So the buying a second home is a decision that most people make for a different reason. Otherwise, it would just be an investment property, right? And so they want to be able to use the vacation home around, wherever it's located. And so renting it out part-time can help offset the cost of ownership. And so that's not really a tax tail wag the dog, you know, and doesn't really usually have a very large impact on taxes because you're not allowed to deduct interest on mortgage debt for your first and or second home of more than $750,000. And oftentimes, especially in my area, in Silicon Valley, which I understand not all of you are here, but most of you are, I think, you probably already owe close to that unless you bought a long time ago. And therefore, adding more mortgage debt doesn't typically add much or any deduction for interest. And because of the SALT cap of $10,000, it's not added any deductions for on the federal side for property tax either. California does not limit your property tax deduction, so you get um, a deduction on that side, right? So buying a short-term rental is something we'll talk about towards the end a little bit. That is a very popular tax strategy that has been talked about a lot on social media, and therefore I would assume that most people undertaking it are doing so for the tax benefits because a short-term rental is not treated as passive income, and therefore the losses are not limited, which we'll talk about later on, right? And so but once you're done with those tax savings, assuming that they play out the way you're expecting, which it doesn't always do, which we'll also talk about later, you still have a short-term rental, right? You still have a mortgage, you still have property tax, you still have to pay a manager or manage it yourself. You still have to pay to clean it, to list it, to advertise it. And so if it's not a sound investment underneath it, then you're going to not come out ahead, right? And then also the short-term rental strategy tends to generate losses by accelerating depreciation, which lowers your basis, meaning that when you sell, you'll have to pay more tax. And so, yeah, we'll talk a little bit more about that later, but I would definitely say that for most people looking at a short-term rental, it is the tax tail wagging the dog. Absolutely. It is technically possible for your tax savings in the first year to exceed the amount of cash you have to put down on the home, but you still have that property when you're done, and you still have to make sure that it makes sense. So
Other questions
Anyways,
I think will make more sense when you get to that part.
yes. So.
Okay.
So there are many business-related tax law changes, but most of them are not going to be relevant to most people and investors, which is our audience today. So I've only mentioned a couple. One is that bonus depreciation has been permanently restored at 100% for purchases made after January 19th, 2025. If you purchased it before January 19th, 2025, including if you ordered and put down money but didn't actually take delivery until after the January 19th threshold, then you would be subject to a I believe a 40% bonus depreciation rate for 2025. It was 60% in 24, 80% in 23, 100% for 2018 through 2022. I leave it to your imagination as to why that threshold is set at January 19th and not January 1st. So the Tax Cuts and Jobs Act of 2017 had a provision that was delayed many times, but actually took effect a couple of years ago for businesses to amortize or capitalize domestic research and experimentation costs or research and development costs over 5 years rather than deducting them in the year paid, and foreign domestic or foreign research and experimentation costs over 15 years. The tax bill has removed that requirement retroactively and but for domestic expenditures only. Foreign research and experimentation or research and development costs are still amortizable over 15 years. There was also some confusion, a lot of confusion about what research and development meant. And it was clarified at some point that they meant really like in a lab setting, not necessarily like, so software development didn't really qualify for that. But a lot of like medical and biotech companies would have a lot of those expenses, et cetera. So. There is a new deduction for seniors. It is not no tax on Social Security, surprisingly, even though the Social Security Administration sent out that email saying, hey, guess what? There's no tax on Social Security anymore. Or something, I'm paraphrasing, right? There is a new deduction for seniors that is not tied to Social Security. So even if you're not collecting Social Security Social Security benefits, but are over 65 and fall within the income guidelines, you do qualify for it. It's $6,000 for a single person and $6,000 per qualifying taxpayer on the return, meaning that if both spouses on a joint return are over 65, it would be $12,000. With the income limit being quite low, however, adjusted in gross income of more than $75,000 single or $150,000 joint will have that deduction reduced all the way down to zero eventually. So for a lot of people in this area, can't pay the bills on that kind of income, and it probably won't be relevant for them. However, if you do have income within those ranges and over 65, you will get this new deduction for the next couple of years, 25 to 28. So again, it's not a deduction against Social Security income. It's a deduction against federally taxable income. Similar to the tip and overtime deductions, it's not an IRS deduction and does not reduce AGI. It does reduce federally taxable income. So, and the taxpayer or spouse must have a valid Social Security number on the return, included on the return, in order to claim this deduction. This has been a new requirement added to a couple of the things that we've talked about. What I haven't said is that the IRS is authorized or empowered to treat if you claim these deductions or credits and don't include the valid Social Security number, the IRS is empowered to treat it as a math error, meaning that they'll just automatically adjust it and don't need to go through an audit process or anything like that. So a math change error is appealable. In fact, they actually just passed a new law that clarifies exactly what those notices have to include. It's wild to me that the Congress had to actually pass a law to the IRS saying, hey, if you make a change to someone's return as a math error, you need to explain it. But apparently that was the case. We did get some notices in the past that were not well explained. And even sometimes when we looked at them as tax pros, we would not be 100% clear as to what they were changing or why. So those should improve going forward. So there's also a deduction available for 25 through 28 for interest paid on qualifying car loans. The limit is $10,000. The maximum deduction is reduced with taxpayers with adjusted gross income over $100,000 or $200,000 for joint. It is only for personal use vehicles that are new, not used, and the original use originated with the purchaser, and that were primarily assembled in the United States. So the Department of Transportation, I believe, maintains a list of manufacturers and models that qualify for this. And so, but the dealer should also be able to tell you, because they have to report it, I believe, to the government, like with the energy credits or the vehicle credit, the electric vehicle credit. Sorry. The loan must be secured against the vehicle with a first lien, and refinance loans do qualify, but you can't, the balance can't exceed the original loan balance. You cannot claim this for commercial vehicles or vehicles with a salvage or scrap title. And yeah, it has to be purchased new for personal use. And yeah, you get this thing. So the IRS released a couple weeks ago a mock-up of a 1099 form that they're creating for auto financing companies to or persons, I suppose, to report that interest amount for qualifying loans. I don't know that it will be available for 2025, but it might be. I'm not sure. There is a kind of a transitionary issue because, this law didn't exist before July 4th of 2025. And so there's, people that purchased cars or made loan payments, before that would not qualify. And then there's people that purchased and after the 4th of July. And sorry, that's not quite right. So because this one doesn't start on July 4th. So there's people that would have purchased and made payments of interest before this law took effect and when it didn't need to be reported. And so there's going to be a little bit of chaos, I think, about it. So are there any questions? I imagine there should be.
Yes, there are questions. Does the
Mhm.
senior deduction apply to state taxes?
It does not. It is
Uh,
all of these new provisions are just for federal purposes. California has not um, complied with any of them that I know of. There are some other states where their calculation starts with federal taxable income, and sometimes there are adjustments to that afterwards. But so it may indirectly apply to those states. But for California, which I imagine is the vast majority of our audience, including myself, that will not apply.
Is the 6,000 prorated in case the spouse is deceased during the tax year?
No, on a joint return, sorry, if the spouse is deceased during the year, you still file a joint return, and therefore would still get to $12,000 if your income qualifies.
How does HSA state tax play out for people who are not a CA resident anymore? Would it be for the state they're now a resident of?
Yeah, unless they recognize HSAs, unlike California. So I was trying to think through the question. Yeah, once you're no longer a California resident, you generally aren't subject to California income tax anymore, and therefore whatever income you have in any account is no longer California's concern, whether they acknowledge that or not.
Any idea why salvage vehicles for personal use are excluded?
No, but I mean, I guess a salvage car is not new by definition, so I'm not really sure why they had to make that carve out. So, I mean, a salvage vehicle is one that was owned and had an accident, correct? So, and was written off by the insurance company. So it's not a new vehicle whose original use started with the taxpayer and therefore wouldn't qualify to begin with. So, um, I think it's, these are type of things are put in that, Americans tend to approach the tax law or law in general as if they don't say you can't do it, you can. And this may be just kind of trying to head some of that off, although there are always people that are more creative than the people writing the laws. So
Can a person take a loan against a 401k instead of withdrawing to avoid the distribution and take a hit on qualifying for Obamacare subsidies?
sure.
But that's within the plan requirements, right? If the
Yeah, the
plan
plan
has.
has to allow for a loan and you have to pay it back. Is anything you don't pay back is then treated as a distribution in the year where you didn't pay it back. So it can be an income shifting strategy if you have that. But yeah, the main concern with borrowing against 401k is that if you lose your job, then you have to pay the money within a certain amount of time or else it's treated as income. But yes, that is, money you borrow is not income. So, from any loan. So money you borrow against your house, money you borrow to buy a car, money you borrow against your 401k, et cetera, or even a margin loan, on your investments, those are not income. And so they do not impact AGI and therefore would not impact things like IRMA or your Obamacare subsidies. So
Does it only apply to new cars bought in 2025? I bought a new car in 2024 and like to refinance.
it
So I
only
can,
applies for new vehicles purchased in 2025 to 2028. So unfortunately, they're out of luck.
okay, thank you. That's all.
I think we're at a break, are we not?
Yes.
10:09, we can take a break, yes.
Yeah, so I think we'll take a short break and then I'll let the host say how long that'll be and when we should return.
Okay, Deborah, should we do 10:20?
10:20?
Yeah,
Yes.
10:20, we'll start up again.
Okay, great. I'll see you all in about 10 minutes then. Thank you.
Okay, I guess we're ready to start again, Russell.
All right. Well, it was very convenient that the break time came after I was done with 2025 and before I started 2026. I'll pretend that was intentional. So, anyway, so some of the new laws from the big bill in this year won't take effect until next year. So these, we spent a little bit of time talking about some of those that are taking effect on January 1st of 2026. So, quick update for 2026 numbers, similar to the ones we had earlier in the presentation for 2025. Standard and deduction amounts are listed. HSA limit is increasing from $4,400, increasing to $4,400 for a self-only coverage or $8,750 for family coverage. Gift limits are remaining at $19,000 per year per taxpayer per recipient. And retirement limits have not been officially released, but are widely expected to increase up from $23,500 to $24,000. There is still the $7,500 catch-up contribution for workers who are over 50 years old. That has not changed, and that amount has not changed in my memory. I think that doesn't change. I think that's always been $7,500. So they also have not announced the IRA limit contributions, but I think those are widely expected to increase slightly by maybe $500 or $1,000. But we don't know yet. And because the government shut down at the moment, we don't know when those are coming. So they did, however, officially announce the standard deduction and HSA and all these other things have been officially announced. Only the retirement has been is still left unofficial. So as of the date of this presentation. So there is a change which is permanent, unless they pass another law to change it again, to charitable donation deductions. There's now going to be a floor of 1/2 of 1% of your AGI, meaning that 1/2 of 1% of your AGI is not going to be deductible, and anything above that will be. So this is similar to the old miscellaneous itemized deductions, which are now permanently eliminated, by the way, for federal purposes. As well as the medical expenses. They have similar provisions where only the amount over a certain threshold is deductible, and they have implemented this or enforced this on donation deductions starting in 2026. Right, so it does not take effect in 2025. It will take effect in 2026. So the example I've given is that if your income is $100,000 and you donate $2,000, then only $1,500 will be deductible for federal purposes. That's $2,000 less, 1/2 of 1% of $100,000, which is $500. And that's going to be, this is not a temporary tax measure. So until it's changed, it's going to remain. So, and California has not followed suit. I don't know if any other states have. So the disallowed amount would be deductible for state purposes, still assuming you itemize. So a long time ago, pre-2018, there was a limitation on the overall amount of itemized deductions, which was informally called the PU's limits. I can't remember if that's a person or an acronym, but that's what it was called. They were suspended by the Tax Cuts and Jobs Act of 2017 for 2018 to 2025. Now they've been officially eliminated. As has the personal exemption deduction and the 2% miscellaneous itemized deduction. Both of those were suspended by the TCJA and have now been permanently eliminated. So that doesn't really have an effect on anyone because of already not getting those deductions for the last 7 years. But they will not be coming back in 26 as was originally scheduled. So, and there's a new strange provision that says that people in the 37% tax bracket, which is the highest individual income tax rate you can pay, typically for income above $500,000 or $600,000 that's taxable, your deductions will only be reducing your tax at a 35% rate, rather than, I mean, up until now, deductions against taxable income have always been at the marginal rate because they just reduced your taxable income. But now they're saying that you're still going to pay 2% on whatever your itemized deductions were. I'm not really sure the logic behind that, other than that it was probably a balancing measure to make some zeros add up in theory or something. I don't know. And also new is that non-itemizers may permanently deduct up to $1,000 of donations per year or $2,000 for a joint return. This was previously something that was temporarily done for a couple years. I want to say for like 21 and 22, perhaps during the COVID years. It's now permanently enacted, meaning that even if you don't itemize deductions, you can still claim a deduction for any donations that you made up to these thresholds. And this is not subject to that 0.5% of AGI floor that we discussed on the other side of the slide. So, so that allows people that are not itemizing to still make a donation to school, church, wherever, and then get a deduction for up to a small amount. So, any questions?
Yes. What does the 37% federal tax bracket statement mean?
So normally speaking, when you take your standard or itemized deductions, you're just reducing the amount of income that is taxable, and your taxable income is then used to determine which, how much tax you are paying. And so, up until 2026, if you're in the 37% tax bracket, then your itemized deductions would be reducing your tax bill at a rate of 37%, at least to the extent that it's in that tax bracket, right? And so now what they're saying is that they're going to cap the benefit of it at 35%. I do not know yet how they're going to implement that, but they're basically saying that, the tax rate or the tax reduction from your itemized deductions will not exceed 35% of your itemized deductions total, even if you're in the 37% tax bracket. For anyone below the 37% tax bracket, this doesn't exist. It's just business as normal for them. So
Catch up senior 7K plus 1K. Is there a tax law change only to the Roth account and not to pre-tax?
can you repeat that for me, please? I missed the first part.
The catch up for the senior, the 1K, does it
Yes,
apply only to Roth or also to pre-tax?
to all IRAs. So people have a overall IRA contribution limit, and that applies to both pre and post tax, and you can only contribute a combined total up to that limit.
Okay. Does that mean if the 37% bracket person's AGI reduces to 32% bracket, they will be taxed at 35%?
If
It's
they're in the 32% tax bracket, then they're not going to be in the 37% tax bracket, and this will not apply to them. So no.
okay.
I'm sorry, back to your last question, I realized that $7,500 catch-up contribution provision, I think they also mentioned, that also applies to an overall contribution limit to both pre and post-tax 401k contributions, or equivalent 403b, et cetera. Sorry, go ahead.
The contribution to the 401k, 403b limits are separate from IRA limits, correct?
They are, yes,
Okay.
but they're not separate from each other. The employer-sponsored retirement plans such as 457, 403b, 401k all have a shared annual limit. I think.
Thank you.
And actually, now that I think about it, I have a client who works at Stanford and contributes both to the 457, I think, and the 401k, each to $23,500. I've never really questioned it. So there may be some interplay there that I'm not 100% on. But generally speaking, they're going to share the same limit overall, just like the IRAs. Sorry.
Okay, thank you. I think that's it for now.
Okay. Yeah, for some reason, I've only ever seen that in this one specific employee that works for Stanford. So I don't know if they have a special arrangement there or not. So
Hopefully the employer would be limiting it if there was a problem.
I would expect that to be correct. Yes. If they're putting it on the paycheck and the W-2, it should be allowed. I just don't know why. So opportunity zones are permanently revived starting in 2027. So this is a little bit further. This is not 2026, it's 27. Opportunity zones were created by the Tax Cuts and Jobs Act bill of 2017 and allowed investors to reinvest or roll over capital gain from any investment or any capital gain, short or long term, from any source into a specific type of investment, which would allow them to defer paying federal tax on the capital gain up until 2026. And then if the there were some provisions early on that haven't been relevant in earlier years, because you had to, if you left the gain there for, if you deferred it for, I think 7 years, in other words, if you did this early, then you could take a discount of like 15% off the federal gain. And when you had to pay it in 2026, and for 5 years, I think it was 10%, 5%, I can't remember which, I'm sorry. And so this has been revived. Of course, if you did this, then remember that in 2026, you will need to pay that tax that you deferred from prior years and plan accordingly. I believe it's going to be treated as if the tax was assessed on 12/31 for estimated tax purposes. So, yeah, so this has been renewed and made permanent. I don't know exactly how it's going to be implemented yet. I believe there's supposed to be a rolling, like 5-year period or something like that, that is going to apply for the deferral date and the discount date, but they haven't actually announced how they're going to do that yet, as far as I know. So the benefit of the other benefit of the opportunity zone is that if the investor owns the investment for at least 10 years before selling, then when they sell it, the sale price is deemed to also be the basis, meaning that there is no gain federally for that investment. And so the opportunity zones are areas that are underperforming economically, and they're designated by each state. And this is a way to use tax incentives and a favorable tax treatment to entice investors to put their capital in areas that need the development. And it focuses on real estate and businesses that are within this zone, within those zones that have been designated. At least in the past, parts of downtown San Jose were actually designated as an opportunity zone, which was a little surprising to most people, including me. So, but they're all over the country. Most investors have already encountered this or are aware of it, but it's been renewed, which they may not know. So, yeah.
One question about them. Is there any talk of allowing QOZ contributions to be made in cash and not just in appreciated securities?
I'm not aware of any way to make a contribution to a QOZ in appreciated securities. It's always been cash. I mean, you invest cash into a fund or business that is working on an OZ project, basically. If there are individual arrangements where that they will accept property in lieu of cash, I've not run into them, or no one's ever mentioned it to me. So I'm not really sure I understand that question. So
Yeah, that's it.
yeah.
If he
So
needs to additional, please enter it in the
Q&A.
Q&A.
Yeah. So I've been saying over and over again, federal, 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 not California. California has nothing to do with this. You will pay full California income tax in the year the gain is realized, and will also pay California tax on the gain, or when you sell the property after 10 years. So keep that in mind. The way I've seen a lot of these structured over the years is that there'll be like really large institutional, syndicated real estate developers, and they'll they'll build the property in the first couple of years and then refinance it and make a cash distribution to the partners so that they get their money back, or at least some of their money back, sooner than after 10 years, right? And then they still own the property for 10 years, or the partnership interest, and therefore qualify for that tax-free gain. So in the meantime, they'll start renting this out, providing cash flow to the investors if it's a good property, and then also depreciation losses, which lower your basis. But then when you sell the property and your basis for federal purposes gets reset to the sale price, then that's not relevant. So this can work out in your favor for the right property, just like any project, just like any investment, you have to assess its risks and whether they align with your tolerance and investment goals, right? So, but that is one way I've seen that a lot of them were kind of getting around the 10-year problem. And then the other thing was that they would typically make a cash distribution to the partners in 2026 to cover the tax on the capital gain that was deferred. So as we go into the end of 2025, there are some things that we are going to consider. Much of this is a repeat from last year because the things that were relevant then were mostly still relevant today. So but it is good always to refresh yourself on things to do. So you can look at your gift limits if you have a gifting plan or a plan to give money to family members, friends, your favorite tax preparer, or whoever, right? You can gift up to $19,000, and then in January you can do another $19,000. So you can kind of bunch up your gifts at the end of one year and beginning of another if you need to transfer a larger amount and don't want to file a gift tax return or use up your annual contribution, your lifetime contribution. I'm sorry. You can always review your retirement and HSA contributions to see if there's room to make additional ones. Both of those can be actually made. Oh, I'm sorry. IRA and HSA contributions and self-employed retirement contributions can be made up until April 15th. But things like your 401k and other employer-sponsored plans typically can't be contributed to until after 12/31, right? Review for unexpended flexible spending accounts or FSA funds, because those are typically use it or lose it. That is distinct from the HSA, which is becoming more common, the health savings account, which is not use it or lose it. You can keep that money as long as you want, and until you take it out, it's yours, right? But for a lot of employers that still have flexible spending arrangement accounts or cafeteria plans, as they're sometimes called, because you can pick. Sometimes it's medical, sometimes it's childcare, sometimes it's life insurance or whatever. So they're referred to generally as or collectively as a cafeteria plan. But if you have those funds, then typically you have until I want to say March of the following year to use those funds for childcare or medical expenses, or to reimburse out-of-pocket expenses that you paid for separately, or else you typically lose it. So, and of course, if you have not yet taken your required minimum distribution for 2025, you want to make sure that that is arranged. Many custodians seem to have a policy that, if you don't tell them to send you money, they will at the end of the year anyways, like up to the required minimum, if you set it up that way, so that you would never not take your RMD. But if you're not one of those, or if your account isn't one of those, and you have not yet taken out the required minimum distribution, then you can review that. I have one client who takes a look at his RMD for the year in December and then has taxes withheld to cover what would otherwise be his estimated payments for the year from that distribution. And the benefit of doing that is that withholding, when we talk about underpayment penalties in a little bit, is treated as being made equally throughout the year, even if it's done in December. And so if you have a shortfall, that's something that you could always take a look at if you're already planning to make a distribution. It can be a way to manage your cash flow, keep the money during the year invested, and then still get credit for paying it throughout the year instead of actually paying it throughout the year. So underpayment penalties is not a simple topic. So when you get a copy of those slides from Lynn, you can always take a look at this. But in general, if you think, well, they're literally a late payment penalty or late payment interest, if you want to think about it, right? It's 7% currently, which is the interest rate that the IRS and state charge. And it's on the difference between what you were supposed to pay during the year and what you actually paid. And so it's literally them saying, hey, you paid this late, even if you paid it by April 15th, right? Because if you don't pay enough during the year while you're earning the income, their stance is saying you owed this money back then and you didn't pay it until later, and therefore we're going to penalize you. So if you get an underpayment penalty letter from the IRS or California, or see it on your return, that is what they are saying, right? So you are supposed to pay the lesser of 90% of your 2025 tax, or 110% of your 2024 tax, whichever is lower. That is what is referred to as your safe harbor, because we don't know what your tax is going to be until we file your return. Even I don't know what your tax is going to be because we don't have perfect information about what all of your income and deductions are going to be until the end of the year when we get the final reports, right? And so this is a way that they've kind of given people a little bit of flexibility. So if your income is much higher this year than last year, then typically you can target 110% of your 2024 tax and know that at least if you owe more, you're not going to have this penalty and can hold on to that cash. Another way to look at it is there's literally no benefit to paying more than this threshold early, right? So, or sooner than you're required to. And so you might as well hold on to that cash, even if it's just cash sitting in an interest bearing account, you're going to get 3.5% or 4% on it. It's better than nothing, right? But on the same token, if you have that cash sitting in a 3.5% or 4% bearing interest bearing account, it doesn't make sense to not make these payments and avoid the 7% interest that they're going to charge you on it, right? So at least up until your safe harbor, make those payments. If you have to liquidate investments in order to generate the cash, then it's more of an investment decision saying, what is my rate of return over here versus the 7% I'm saving by making a payment? And then my general approach to this with my clients is if I tell you what you need to do and you decide to do differently, then that's fine, right? That's your choice. You know what you're doing, or at least you know what you're deciding. What I try to avoid is them not knowing what they need to pay and just letting the default be the underpayment penalties, even if they had cash to make the payments, right? So California has similar rules, except that if your taxable income is over $1 million, the only safe harbor they will provide is 90% of your 2025 tax. So that is something to be aware of, and that does get cut in half if you file separately for California. So which means that if your taxable income on a separate return is over $500,000, they will not allow you to use the 110% of 2024 safe harbor. So by default, both agencies assume that your income is earned evenly throughout the year. But you can also have there's a long form of the calculation that where you can tell them, no, this much of my income was within this period, this much in that period, et cetera, in order to consider the timing of your income. Because if you have a large capital gain in the fourth quarter, you certainly shouldn't be charged underpayment penalties for quarters 1, 2, and 3, right? And so, but if you don't tell them when your income was, they will assume it's equal throughout the year and calculate that accordingly. Now, I haven't used TurboTax in over 25 years or a similar software. I don't know how easy it is to do the manual calculation or the long form calculation in there. I know that for us, it takes a lot of manual work where we have to actually go figure out what income was in which quarters. And most preparers are not going to do that because it's annoying, right? Or at least not do it for free. I always do, or at least I give the client the option to if they want to tell us when their income was. But that's something to be aware of, that just because you see an underpayment penalty on your return when you're done doesn't mean that that's the final word. If more of your income was in the first half of the year, or it really was earned approximately equally through the year, then it's probably fine. If more of your income was assessed or earned in the latter part of the year, then it probably makes sense to take a look and see if you can reduce that penalty by factoring in the timing of the income. And quarters for this purpose are not really quarters. The first one it's March 31st. The second quarter for tax purposes is May 31st, at the end of May 31st. And then the third quarter is at the end of August 31st. And so for each estimated payment is going to factor in income that was due up through that date. And so on the April 15th estimated payment date, they look at income through March 31st, for June 15th through May 31st, and through September 15th through August 31st. And then so any income earned in September, October, November, or December, which you may count as 4 months, and you'd be correct, would be due in January 15th of the following year. And so it can be very impactful to take a look at this and do that extra legwork if you are not, or to ask your preparer to do that if they are not. So, and you'll see that the IRS form is called 2210-2210. The state one is, I think, 5805. And they're about 4 pages long each. If you look at your return and you only see the first page, that means they have not done the long calculation and are just assuming that the income was earned equally through the year. So just a FYI. A simplified calculation of this to show how it works is shown on the screen, where if you have someone that paid $40,000 of estimates but owed $100,000, then they would be subject to that underpayment penalty of $60,000 for the year, and they would divide that, saying each quarter was 15,000. I'm just trying to keep the math simple here, right? And so, and how it's calculated, they take the number of days. I actually did not update this to 365 days from last year. I apologize. I updated the year numbers, but didn't realize that I had 24 was a leap year, so it was 366 days. 25 is not, so it's 365 days. So, but they would calculate the penalty accordingly, right? They'd say how many days late is it for this percent of the tax, and then multiply that out by 8%. And so in this case, it'd be $3,192, which is pretty substantial. And you'd say, okay, well, that's the cost of using that $60,000 during the year, leaving it invested, leaving it in cash accounts, leaving it liquid, et cetera, right? And so chances are very high, if not, if it's just cash, she didn't earn $3,200 on that income or that money. If it was invested, then it depends on how well she did, right, in her investment. So, so again, I usually just say, make a choice on this and know what you're doing, or know what you're choosing rather. Don't just pay your, in Silicon Valley, we have a lot of high earners that owe a lot of money to the IRS every year, and many of them pay penalties. So we try to at least educate our clients on how this works, give them an opportunity to minimize it, because oftentimes the taxes due to equity compensation, such as RSUs, that happen periodically throughout the year. And so sometimes it does happen that a lot of income is made in the fourth quarter instead of all through the year, et cetera. So anyways, I'm saying that, sorry, in Silicon Valley tech worker communities or collectives, it seems like it's just kind of expected that this is the way it is. You're going to have to pay a lot of money every April, and you're going to be penalized for underpayment, and that's just how it is. That doesn't have to be just how it is. That's my message. So, loss harvesting is something I get a question about quite frequently, especially from new prospects that are looking for guidance. It's really very straightforward. Capital gains and losses are netted out at 3 levels on your tax return: short-term gains versus short-term losses, long-term gains versus long-term losses, and then the net short-term gain and net short-term loss against each other, right? And so if you have a large capital gain and sell a position at a loss, then you are reducing the amount of taxable gain you have, right? It is literally that straightforward. And because of the 3 levels of netting, you can always look at it as a short-term loss can sometimes offset in a long-term gain, and vice versa, right? A long-term loss can sometimes offset a short-term gain if there's an overall net short or long-term loss, right? So, and that also will be netted against capital gain distributions from your mutual funds and ETFs, or capital gain that is passed through to you by K1 from an estate or a partnership or an S corp, et cetera, right? So that is literally all that loss harvesting is. And so oftentimes at the end of the year, investors will take a look at their portfolio, look for lost positions that they don't necessarily need to stay in anymore, and choose to sell some of those before the end of the year in order to offset any gains they had from more successful investment positions. So I forgot to change 2024 on the slide to 25, please excuse me. So yeah, so it doesn't matter when in the year the capital gain is or when in the year the capital loss is, other than for underpayment penalty purposes like we just discussed. So you can sell a loss in December to offset a gain from January, or vice versa. So, and again, I guess if you have net losses for the year, then sometimes you want to harvest gains if you have successful positions, and therefore use those losses that you already incurred to shelter capital gains from tax. And this will work both for federal and state purposes. So are there any questions? I haven't had any for a while, I think. Yes,
Yeah,
sorry.
well, there are questions. Aren't you almost done?
Yes. Would you want to save them for the end?
Yeah, I think at this point.
Okay, that's fine. I also get a lot of questions about wash sale rules. They're fairly simple in concept generally, but there are always some things that kind of can complicate it. But the general rule is that if you sell an investment at a loss and repurchase or acquire that same investment within 30 days of that sale, then your loss gets deferred. It gets added to the basis of your new replacement property. As far as I know, this still does not apply to cryptocurrencies. So you can't always, some people use that as a loophole. they can sell a cryptocurrency at a loss and then repurchase it immediately and not have a wash sale. Yeah. And so all you have to do is wait 30 days. So if you don't want wash sales to trigger, sell all, don't sell what you want to sell before the end of this year, and don't repurchase it until at least 30 days after the start of the new year. If you're using this for loss harvesting, right? If you do repurchase it, then that loss would not be used to offset income in 25 like you might expect it to be. So, and year-end donations, this is a conversation I always have with my clients, but especially this year because of that 1.5% of AGI floor that's being introduced starting in 2026. If you have planned giving for 2026, you may consider accelerating some of that giving into 25 to avoid that floor, if it makes sense to do so. You can also influence the timing of the distribution versus the donation deduction using something like a donor advised fund, which is a charitable fund that I think all of the, Fidelity has one, Vanguard has one, Schwab has one. Those are the three main ones these days. I think everyone else has basically been bought out. That you can make a contribution to the charitable fund now and take a deduction for what you donate, but then actually to distribute those funds to the charities on your own schedule, right? And so if you said, well, we're planning on giving X number of dollars to this charity next year, or we give this much every year, you can consider donating a larger amount now into the DAF and then distributing that money from the DAF to your charities on your own schedule. Because in my experience, if you give large amounts of money to charity, they kind of expect you to keep doing that. So, and so if you want to time out you schedule out your donations more regularly, then this is a way to do that, but still get that tax benefit now before that AGI floor gets introduced next year. So the other thing that is nice to do is to donate appreciated stock or other property to the charity instead of cash, because you don't have to sell the property and therefore don't need to pay tax on the appreciation, but you're able to still claim a deduction for the fair market value of the asset. And so, and most larger charities are equipped to handle these stock donations directly, but you can also use a donor advised fund to accept that stock donation and then generate cash to donate to smaller organizations such as a PTA, a church, etc., that isn't equipped to handle stock donations easily. So, and then, yeah, I think that's about all I have to say about this. Yeah. I have one client who on December 31st of every year goes and makes his stock donations to his alma mater. And so it usually tends to be like on the last day of the year. He's like, oh, wait, I have to do this thing. So if you can at least be a little bit more thoughtful about your planned giving towards the end of the year if you start now. So.
Okay, a number of questions have come in if you're ready.
Sure. I just listen. No, but that's fine. We can go through the questions.
Oh, I'm sorry. I thought you were done. Go ahead.
Nope. No, I don't mind answering questions now. It really doesn't matter to me. So.
Does the wash sale apply if one sells stock from one taxable account and buys same or similar stock in their IRA? How about buying back in the spouse's IRA?
Technically, yes, but good luck catching it. So, I mean, so the brokers will track wash sales within your account, but they don't have the ability to share information to, know what you sold at what gain or loss in a different account, right? And then the IRS and analysis of transcripts isn't sophisticated enough, as far as I know, to flag that automatically. So. Nor would individual stock sales inside an IRA ever be reported to the IRS because they don't go into 1099-B. So.
But technically, you would lose the loss, correct?
Yes, technically, yes.
Can the taxpayer choose to not take the net capital losses against ordinary income and carry it forward?
Generally, no. So net losses, I may have been on the slide, but I didn't say it. Net losses are limited to $3,000 per year, and any excess would carry forward. I believe there's some rule that says, like, if you didn't file a return because you didn't have a filing requirement, that you don't lose $3,000 per year if you have a loss carrying forward. There is no provision saying that if the $3,000 deduction doesn't benefit you, that it doesn't get deducted from the carry forward, as far as I know.
Do contributions to a donor advised fund qualify for the extra 2,000 charitable deduction beginning in 2026?
I think they
Doesn't,
do. I'm sorry, something in my brain is saying there was something about a donor advised fund or a foundation or something in the new tax bill, but I don't recall the specifics offhand. I believe they do.
but it has to
Yeah.
be in cash, right?
Uh, no, I don't believe
No?
there's any. I don't think that non-cash donations also qualify for that $2,000, $1,000 donation deduction. I may be incorrect on that though. So if someone knows differently, please speak up. So um, there was a thing about QCDs not being able to go to a donor advised fund, and that's been a long-standing rule. I believe it has to go directly to a charity. So, but also there's not really well, there's less incentive to space out QCDs compared to um, regular donations. So
How to best leverage donating appreciated securities to a DAF to maximize IRA to Roth conversion?
sure. Yeah, that's a valid way. You're saying that when you do a Roth conversion, you have additional taxable income, and you offset that with a donation to a charity. Then to help minimize the actual tax impact to your taxable income, there's absolutely nothing wrong with that. So
There is a limit if you donate securities, isn't there a lower limit to what you can deduct per year than cash?
I believe it's 50% instead of 60%, but I've literally never run into that unless the income is like very, very low. So, and then the excess would carry over.
To follow up an earlier question, for a large capital gain taken in December, am I correct to say I can make an estimated tax payment by January 15th of the following year to avoid an underpayment
That is
penalty?
correct, but you'll need to use the timing, to use the long form of the 2210 and 5805 if you're in California, to make sure that they calculate the penalty accordingly, that you didn't have that gain in the first 3 quarters. Otherwise, by default, they will assume that it was earned in, 1/4 of it each year. So yes, that is correct, but you'll need to put in some legwork, or your preparer will. So
What if I have made quarterly payments and your income will be substantially less? Should I adjust down the January 15th payment?
I would say yes. There's no requirement that you pay in more than you have to. Typically when you prepare a return yourself or have someone prepare for you, an estimated tax payment schedule is going to generally be assuming they're trying to hit that 110% of the prior year, because that's the number that we know, right? 90% of your current year is a moving target, and we don't always know what that's going to be. We can estimate it sometimes. That takes extra work though, right? So the default assumption is generally going to be 100 or 110% of the prior year, depending on how high your income is, right? And so if your income is lower, there's no requirement that you make that fourth quarter estimated payment as scheduled. It may be appropriate to reduce it or even skip it, depending on what your actual numbers are. So if you are using a preparer, you might reach out to them and ask them for a workup of 2025 or projection, and to kind of estimate whether this payment needs to be made, or if it should be adjusted downward, or perhaps even skipped. So
Speaking of worse sales, is there a list we can see of the IRS judgments of what is substantially similar securities? For example, there are various S&P 500 index funds as mutual funds, ETFs, and synthetic positions with options. How can we
that
determine what the IRS regards as substantially similar?
I believe you'd have to look at tax court cases to do that. That's beyond the scope of this webinar. Sorry. So, and I've never actually come across the question in practice. So that would be something to research on your own. So I can
Yes.
understand the question. They're saying like, hey, if you sell an S&P index from this fund and buy something similar, another fund from Vanguard instead of Schwab, does that count as a wash sale? I don't know the answer offhand. So
Since the IRS always wants more money, what is the reasoning behind having the 12,000 senior reduction applied to taxable income rather than AGI?
if that's how Congress passed the law or
Okay,
wrote the
no
law.
logic is required. Okay.
Yeah, that could be kindly stated that way. Yes. In polite company. Yes. Now, logic does not always apply to the tax code. This is another one of those things that's being used for, it's going to benefit a lot of people, and there's no doubt about that. And it is targeted towards people with lower incomes. So it's going to save them money who could probably use it the most, right? But this is a political gambit, and therefore, as is the tax on the deduction against tips or OT, and it's mostly engineered to score political points rather than actually being sound tax policy, as far as I'm concerned. So it doesn't mean it's bad. It just means that it's not meant to make sense. It's meant to score points. So
The 2000 charitable deduction, there is a statement that Google states that donor advised funds do not qualify.
thank you for sharing that. That may be correct.
How does the IRS abatement work for innocent mistakes, negligence? Any rules to be aware of?
So we haven't talked about that, but that's fine. I don't mind going into it a bit. The IRS does have a first-time abatement policy that is actually not first time. It's if within 3 years you haven't made a mistake like that, then there are many penalties that can be abated automatically upon request. And typically you just call in or write in and ask for it, and if it qualifies, they'll grant it. Beyond that, you need to provide what they call reasonable cause, meaning that there's a reason outside of your control that would make anybody, not just you specifically, in that circumstance, be unable to avoid that penalty, right? This is granted very, I guess we could kindly say it sparingly and unkindly call it begrudgingly. To the government's position is that penalties and interest enhanced voluntary compliance is what they say, right? They're saying that if we don't penalize you for not complying with the tax law, then you're less likely in general to voluntarily comply with it. And so there are always circumstances outside of your control that might qualify for penalty relief. You will not get relief from interest unless it is an error that was on the IRS or state side. Their agency made an error that delayed the payment of this or the assessment of it, and therefore so generally you can get penalty abatement. So it most commonly has to do with like your health or the health of someone that you're in charge of caring for. And you need to be able to document when that circumstance started and when it ended. And then the abatement will only apply to that specific period. So most of the time we do first time abatement. California has recently introduced for individuals only, not for businesses, a one-time abatement of penalty, and it's literally one time for each taxpayer. So use that judiciously. So in the similar process, you write in or call in and ask for it. They'll tell you whether it qualifies and then whether it's going to be abated or not. So, but it is one time, not IRS is every 3 years potentially, right? And it can apply for IRS's penalty abatement can apply for late filing penalties and late payment penalties generally. California's, I don't know that I think it's similar, but it's only one time, not every 3 years. So.
There's a statement that the reason the Stanford employee can contribute to more than the 401k limit is that 457 plans are not aggregated with the other plans.
Great to know. Thank you. 457s are typically only used for government employees, and that's why I wasn't sure offhand. But that is a great point. Actually, you know what? No, that is actually 100% correct. I had a client once who worked as a dispatcher for San Mateo County and contributed to a 401k and 457, and then also had self-employment income and contributed to SEP IRA as well. They were trying to retire by the time they were 50. I hope that they succeeded by now. So.
Was a large loss carryover to be amortized by 3K over several years have to be reported on every tax return or noted year over year or to retain the loss credit?
Every year that a return is filed, yes.
This one, to reconfirm, if I pay 90% of my 2025 or 110% of my 2024 tax by December 31st or April 15th to avoid underpayment penalty, which date?
So the penalty for underpayment is calculated by the day, meaning that if you meet your safe harbor threshold on December 31st, then you may still owe penalties for the first, second, and third quarters, right? And then but the fourth quarter The fourth quarter underpayment penalty would be from January 15th to April 15th of the year when you'd be avoiding it. So I think that answers the question that they were asking. If not,
I
please
believe so.
clarify it with put in another question. So
Does the CA tax 6% penalty and interest to on Roth excess IRA? I think this is, does CA California
I
excess
don't
penalty? Go ahead.
know, actually. I don't know the answer to that. I'm sorry. I mean, you're
Okay.
asking like, the excess contribution penalty of 6%, does California assess one as well? Honestly, I've never paid a return that had that penalty on it, so I don't know.
How many years back should one keep copies of their tax returns?
Tax returns, I would say indefinitely. Technically, the IRS has 3 years to audit a return after it's filed or due. But the tax return itself doesn't take up much space these days, especially since most of them are digital, right? I also recommend keeping W-2s indefinitely, or at least until you confirm that they match what the earnings records of the Social Security Administration say. Beyond that, 1099s, bank statements, and stuff like that, I would say 3 years, right? After 3 years, you can dispose of your other documents, but I always recommend keeping the tax return itself and W-2s indefinitely. Not required, but that's just my recommendation. So I
And if
actually
you,
did have a client once, or a former client, ask if they could get a copy of their W-2 from like 2006 or 5 or something like that. Which unfortunately was the year after they had started working with me, so I didn't have it. But it was because the Social Security Administration earnings record wasn't accurate, and that can sometimes benefit or affect your benefits. So
if an amendment is done, does the 3 or 6 year period get clocked again for the years going back?
only for the change. But the common misconception, even amongst preparers, if the only changes that would have a 3 year statute, I'm sorry, only the changes would have the 3 year statute reset. The rest of the return would still run from the original filing date.
Retired on Social Security income, if I owe taxes, should I pay this quarterly or the latest by April 15th of the following year while filing the tax return?
It depends on whether you have, an underpayment penalty threshold, right? We talked in the other slide about your safe harbor. And so if you paid in enough to meet your safe harbor, then you don't need to make an estimated payment. And if you haven't, then you should consider it.
Is my total amount of charity gifts subject to a floor of 0.5% of AGI, or is each gift subject to the floor?
It's the overall total is subject to one floor. That's a great question. And I can understand why they would have that question. Yeah. It's an overall floor for your combined donations.
I thought the catch-up senior contribution cannot be put into a pre-tax account. I thought start of 2026, the catch-up can only be contributed to a Roth account.
I believe that that applies for certain high earners, but not for everybody. Yeah, there was a provision in the Secure 2.0 that said once your income goes over a certain point, or if you're considered a highly compensated employee for that company, then the catch-up contribution has to be Roth. But that's not for everybody.
And is that only for employer plans or also for IRA?
IRAs, no, that's not for IRA. That's just for the employer plans.
Can passive losses for rental in Washington be used with capital gains on a sale of a California rental?
Depends. We'll go into passive losses in a little bit. You can always ask that's a clarifying question when we get there. So,
Okay.
yeah.
Just a general comment. It seems like the tax law changes continue to move in the direction of discouraging taxpayers from itemizing and instead just take the standard deduction.
It does seem that way, and partly that's I think there is an element of an effort to simplify the tax filing process for a lot of people. However, California's itemized deduction or standard deduction is like $10,000 for a married couple, and so a lot of my clients, even if they don't, and then especially with the SALT cap on the federal side, there are a lot of clients that itemize for state purposes that may not itemize for federal purposes, right? So I mean, California has a slightly higher debt limit for for mortgage interest deductions, it's $1 million instead of $750,000. California does not limit your property tax and DMV deductions to $10,000 like the IRS does. And so, and then also California never eliminated the 2% miscellaneous itemized deduction category, which can include your investment expenses, unreimbursed employee expenses, tax prep fees, safety deposit box, et cetera, right? And so I have quite a few clients that don't itemize for federal purpose, would do for California purposes. So yes, but no. And if you're only looking at the federal side, yes, I think that is one of their goals, is to make it so that fewer people have to itemize in order to get the deductions. So
Next question is a little confusing to me. Is the mandatory catch-up Roth Secure 2-point act only for age 50 plus, but isn't the catch-up only for 50 plus?
yes, under age 50, you would not be eligible for the catch-up unless there's some arcane exception that I don't know offhand. So
Does the new SALT 4,000 apply to
40,000,
40,000 apply to 2025?
yes.
Okay, we'll deal with the rest when you're done.
Sure, that's fine. There's not a whole lot left, but there is some. So passive loss limits I touched on earlier, and there were a couple questions that kind of touched on it as well. Passive income is income that comes from businesses that you invest in but don't, and receive income from for tax purposes but don't run, or rental property. Rental property is statutorily, by the code, defined as passive income even if you are actively running it, right? And so a loss from a passive activity, including rental income, cannot generally be used to offset income from non-passive sources. And so instead, you will be the net loss would be suspended and carried over. There are a couple exceptions, which we'll touch on in the next slide, I think. But generally, that's the case, right? So there is for real estate, specifically for people with income under $150,000, there is a carve out that says if you're actively participating in the rental property activity, you can deduct up to $25,000 against other income. Once you're at about $175,000 on the return, that goes away and just gets suspended and carried forward. There are also exceptions for short-term rentals or real estate professionals, which are frankly a bit beyond the scope of this presentation. So, oh, I'm sorry. The loss carries forward until they can be used or until the activity is sold. The passive losses are tracked on an activity by activity basis on Form 4562. 8582, sorry, 8582. And so when you sell an activity, then any associated suspended losses would be deducted in that year. So exceptions, like I mentioned, the short-term rentals loophole, as people like to call it, have been very popular in recent couple of years. A short-term rental is a rental property where the average guest stay is 7 nights or fewer during the year. And that is not considered a rental property anymore. That's considered a business, right? And so even though it is still reported on Schedule E, I will repeat that, a short-term rental is still always reported on Schedule E, not C, then it is not considered a passive activity, and the income or loss is not considered passive income or loss, right? So the popularized strategy is to buy a short-term rental and then do a cost segregation to identify components of it that are deductible and subject to bonus depreciation, or eligible for bonus depreciation, to claim a very large depreciation deduction, and it being a deductible loss against other income, right? So the other half of that people tend not to talk about on TikTok is that you have to materially participate in the activity in order for that non-passive loss to be deductible. And so the short-term rental designation makes the income or loss non-passive, but to make it deductible, you have to materially participate in the activity. There are 7 different tests that you can use to qualify as materially participating. Typically, the lowest bar is to spend at least 100 hours on that activity or in a group of activities if you make a grouping election, and that no one else has spent more time individually on it than you. Right. That's typically the easiest, but there are 6 others. You can always research them or schedule a consult if you have a question about it. So For a joint return, either or both spouses' time can be factored for material participation tests, right? The other exception is I'm sorry. And I mentioned before, that, hey, there was a question earlier about this, where if you take the non-passive loss from the depreciation acceleration, that's valid, right? But you're going to have less basis in the property going forward, meaning that your depreciation going forward is going to be lower because you've taken a lot of it in advance. And also that if you sell it, you're going to have a larger gain because your basis is lowered by the depreciation. If you do a 1031 exchange, then that lowered basis carries forward and you have a lower basis in the new investment, right? Now, I have yet to meet a real estate investor who wasn't willing and very happy to make that trade-off, a benefit now for a potential tax later, right? But I just want to make sure that people are aware of that and making an informed decision. So the other exception to passive loss limitations is for real estate professionals or reps, right? It allows an investor to disregard passive loss limitations with regard to real estate investment income broadly, right? There are many specific requirements to qualify for reps, including that more than half of your time working or on business or making money be spent on on real estate businesses, right? This means that if you have a full-time job, it is basically impossible to qualify. There have been many people who have tried and they have lost every time, including in tax court. And if you're working 2,080 hours or more per year on a full-time job, which is 40 hours per week, right? And you have to say that you have to be able to document contemporaneously 2,081 hours or another 40 hours a week or more of time spent, and that's just not possible, really. I'm not aware of a single time where that's been able to be approved. There have been employees who go, "Oh, but I'm on call, so I'm not really working during these hours," and therefore, in the courts, as far as I'm aware, have never bought that argument. So, and then, but real estate agents, developers, brokers, wholesalers, flippers, and property managers are some of the activities that can qualify as a real estate business. It does not mean that if you have a real estate agent license that you are automatically a real estate professional. There's a requirement that you work at least 750 hours on a real estate business during the year, and that it must be documented if requested. So it's a pretty high bar. If you're a full-time real estate agent, then you are probably going to meet that requirement, but it's not automatic if you do it part-time. And again, you have that other requirement, meaning that more than half of your working hours has to have been spent on real estate trades or businesses. So one last reminder from Nimona, don't let the tax tail wag the dog. But up top, there's also talking about like, hey, IRS has been paying what I would call special attention to returns claiming real estate professional status for a long time, right? Due to a high number of taxpayers who claim it not actually qualifying, right? There's call it a tendency that when you're preparing a return for yourself, especially, that you get the results, find out you owe a lot of money, and then try and find a way that real estate loss that they're not allowing becomes allowable. And one of those ways is to check that box saying you're a real estate professional, right? So the person who used to make this presentation, and Alan Pink is a colleague of mine, represents taxpayers in audit for the company called Tax Audit, which is like if you do TurboTax and it says, hey, would you like to buy audit insurance? Then, if you click yes, then if you get audited, he'll represent you if you live in the Bay Area, basically, right? He sees it a lot. A lot. And that's usually the story he gets from the clients is that, or the taxpayers, that they were just trying to find a way to make their tax bill smaller. So be careful claiming it. There are very specific requirements for it. And because it allows the deduction of large passive losses, it is something the IRS has long paid attention to. I expect that the similar type of attention will be soon paid to real short-term rentals, right? And because for the same reason, people are hearing about this. They're saying, "Hey, this is great." They may or may not qualify for material participation, but they don't necessarily know that they need to, and therefore, yeah, I expect that there's going to be a lot of attention to this. Now, the caveat being that the IRS is shut down with the rest of the federal government currently in November 2025, and that they earlier in the year lost about 25% of their workforce, along with most of the rest of the federal government during the Doge purge early in this year. And so what level of enforcement, I don't know, but they tend to try and focus their limited resources on things that are likely to yield a significant tax change to justify spending their resources on it. So yeah, just make sure that, and this is not to say don't use these strategies. It's saying that if you're going to, make sure that your documentation is bulletproof and that you're prepared in case it is questioned. So yeah, and the material participation and real estate professional time logs are generally expected to be contemporaneous, meaning that you're not just creating it because you've been audited. You can if that's all you have, but it's generally considered a stronger case if you have something that's more contemporaneous, saying, "Hey, this is the time I spent on these activities." Right? And again, don't let the tax tail wag the dog. That's the drum beat that I'm going to continue to beat from my clients and the people I talk to, probably till the end of time. Um, so this is a QR code to my calendar if you wanted to schedule um, a consultation or really a introduction meeting to meet to discuss whether we make sense for us to work together. And then I will open up. This is my last slide, so I will open it up for questions now.
Okay. Can the RMD of an inherited IRA defined as 1/10 the first year, 1/5, 3/10, 2/5, 1/2, 3/5, up to 10/10 in the 10th year?
Is it? I thought it was still just using the normal. Um, no, I'm sorry. It seems like they're asking whether the RMD is designed to drain the account within 10 years. As far as I understand it, the RMD would be based on the overall value of the account and the age of the decedent if they were still alive, just like it would normally be calculated. And then there's a separate requirement that you must drain the account within 10 years.
Is cost segregation a good thing to do for long-term rentals?
It can be if you have taxable income from them or have passive income to offset with the loss. But the same all cost segregation is a great tool, but you have to make sure that you're able to use the losses that it generates, right? Or the deductions that it generates. So yeah, it can be a valid way to reduce taxable income from your rental properties. Or yeah, but just keep in mind that if you have an overall loss, unless you qualify for one of those exceptions we just talked about, then you may not get that loss in year one. You may be able to, if you have cash flow coming out and taxable income coming out in future years, then you would use that loss to offset it until it's used up. So I would just say before you do it, because a good reputable actual cost segregation study requires an engineer to visit the site, the actual property, and to review it and look at the fixtures and whatever, look at the blueprints if you have them, look at the improvements that you've made, etc. They're going to cost between $4,000 and $6,000 typically, right? If you're looking for a cost segregation that's just online and making an estimate, I would personally steer clear of those, right? They'll give you something that looks like a cost segregation study, but will probably not stand up under scrutiny because they did not visit the site and do that detailed analysis. Analysis takes time, time costs money, and travel costs, of course, as well. So
Are you a CPA and file taxes?
I am an enrolled agent and filed taxes. In the first couple of slides, I mentioned that an enrolled agent is licensed by the Internal Revenue Service, whereas a CPA is licensed by the State Accountancy Board. So when it comes to preparing taxes, we have the same rights. Whether you have the same skills and knowledge and experience is not actually determined by your license. It depends on how you do things, right? So yes. I
Aren't
mean, in
some
other words,
admin,
there are CPAs that know a lot more than me, and there are CPAs that know a lot less than me. So, and vice versa. So,
but
anyways,
EAs are allowed to represent you in front of the IRS. Is that
correct. Yes. EAs, CPAs, and attorneys all have the same rights to practice before they represent clients before the IRS administratively. Only only attorneys or USTCPs, which is United States Tax Court practitioners, have the right to represent taxpayers in tax court.
uh, if you realize a large capital gain near the end of the year, are you liable to tax install? Are you liable for essentially underpayment penalty, or is that only refer to earned income?
The underpayment penalty applies to all income tax, right? Or all taxes that you owe for the year. You would want to make sure, especially to the end of the year, like you mentioned, to do the long form of the 2210 to make sure that the calculation of the penalty factors in that you had that income in the fourth quarter only and did not have it earlier in the year. Sometimes doing the long form can eliminate an underpayment penalty. Sometimes it just reduces it. Sometimes it has no effect. So, but usually if there's an underpayment penalty on the tax return, I'll at least look at it and explain it to the client and ask them if they want us to try and minimize it by looking at the timing of their income. As far as I know, like almost no one else does that unless asked.
Florida does not have depreciation losses recapture at the time of sale. Does it mean that cost segregation is good tool for Florida rentals? How will CA react to that if losses are taken now and later someone moves to Florida?
I'm having trouble parsing that question. Can you repeat the first part of it for me, please?
Florida does not have
Oh,
depreciation
Florida does not
losses
have. Okay.
recapture.
Florida does not have a state income tax. So I'm really not sure what that question is asking me, right? Most states are going to have similar rules to the IRS for property that is sold in their borders or for residents, right? And so if you have a passive loss carry forward from California and move to another state that has an income tax, that state may very well not recognize the passive loss carryover from before they were a resident. I think that may answer their question. If not, please clarify. So
If the property is held in California and
yes.
was rented in California, you move to Florida and you
Mhm.
sell the CA property, you're still going to have to file a CA tax return, correct?
Correct. Yeah. Income sourced to California is always going to be taxed to California, and real estate in California is always going to be sourced to California.
So the earlier question you deferred, can passive losses for rental in Washington be offset with capital gains on a sale of a California rental?
So Washington also does not have an income tax. You're talking about
Washington State, I believe, has no income tax.
correct. So again, that I'm still confused by that question. So if you're
Uh,
asking if California, like the United States government, taxes worldwide income. So if you have a loss from a rental property in another state, then it would be still deductible against your California income, subject to the normal passive loss limitation rules, right? Or the fact that you disposed of it, mean that there wouldn't be a limitation. And so yes, that could offset income from a capital gain or other source. I think that answers the question.
for federal, that should be true. Then you're saying it also may be true for California
It should be
state
true for
tax.
California if you're a resident, because California doesn't distinguish where the income comes from. So if you're a California resident, 100% of your income will be subject to California tax. And yes, that loss would offset. If you move out of California, then it depends. So
When do you recommend to take advantage of tax credits versus paying taxes if AGI is high?
depends on the credit. I don't really know. Sorry. I don't really know what specifically they're referring to. So
It wasn't that's solace in the question.
sure.
Does it make sense to deduct 30K in mortgage loan interest if the proceeds lead to a negative cash flow? I assume this is rental property, or otherwise you wouldn't, I don't know.
I struggle to come up with a situation where taking a deduction that you've actually incurred and are entitled to would be recommended. And if it's being used to manipulate your income to achieve a specific goal, then that would generally be considered fraud. So I would say if you paid the interest and it's deductible, then deduct it, even if it creates a negative taxable income. I mean,
Clear,
you could always, if the numbers work out, you can elect to not itemize, right? And to use a standard deduction instead, if that will generate the same outcome. And there's nothing wrong with that. But again, if you're entitled to take a deduction, I put it on the return. So
are property management fees paid to a foreign family member for managing property deductible?
against income from that property, yes, with the passive loss limitations factored in.
Clarification, there is still the advantage of asset step up with QOZs, regardless of how the investments in the QOZ are fund are contributed cash rather than appreciated securities if this is allowed.
I
Investment in Q.
believe, but I'm not aware of any again, I mentioned earlier, I don't know that you can contribute property to a QOZ fund. I don't suppose there's anything that says you can't as long as the partnership allows it. And I don't see that there's any distinction between cash or property when it comes to the capital gain exclusion after 10 years.
Investment in QOZs would be much higher if cash contributions were allowed, but it sounds like cash is the requirement.
As far as I know,
Okay,
I mean, most of the time, so a QOZ activity is to either build a new building or to buy an existing building and rehab it and spend at least as much as you paid for the building, right? So these funds that are raising capital are not interested in property, as far as I know, right? They're interested in cash because that's what they need in order to complete their project. If there are some that are willing to take property, that's, I guess, between them and the investor. So
okay, there's no further open questions.
great. It's about 11:30, so I will happily conclude.
Thank you very much, Russell. That was great.
I'm glad there was a
You-
lot to talk about this year compared to last year. So
Yes,
I'm
a lot
glad
to
that
talk
we were able
about.
to get through it all within the time frame. So, but thank you everybody for watching and attending and asking your questions. Please, email Lynn if you want a copy of those slides. I provided a PDF copy of them to him, and he'd said earlier, email him for a copy of them. And if you need any help or want to talk about tax planning or prep, please use the QR code or go to my website to schedule an introductory consult.
Okay, and there's just a comment. Thank you. Those were a marathon of questions.
That's great. I'm happy to answer because actually I had told the panelists earlier before everybody started joining was that, like, a lot of times the answer is it depends, and I actually didn't have too many of those questions. So I'm glad that everyone was able to ask questions that I was actually able to answer. But I appreciate the opportunity to come and talk to you all, and I look forward to returning next year if I'm invited. So
There's a request to put up the
sure.
QR code.
Oh, let me reshare. Yeah, so this, if you go to svtaxcoach.com, in the upper right corner, you'll see a calendar icon. You can also access my calendar that way. Or this QR code, I believe, goes straight to my Calendly link that would take you to. So
Multiple thank yous coming in. Wendy,
sure.
Sherry, Barbara. So
Mhm.
thank you.
My pleasure. I will look forward to coming back next year if I'm invited.
We need a tax presentation every year.
Yes,
If
we do.
Congress would just stop changing the laws, I would eventually be out of a job, I guess. But it would make things a lot simpler. So
Just waiting for the IRS to try to update the forms by the time required to file taxes when they're shut down and lost
that is
25%.
a very, very real concern that we don't know the answer to. So we know that typically the IRS would shut down their e-file servers around mid-November, or so, a little before Thanksgiving, in order to get ready for the next filing season, and then they reopen them in around late January. This year they're open. They've announced they're going to close them on mid-December, and we don't know what impact, if any, that's going to have on the date that they're going to start accepting returns. In my practice, I don't really need to worry about that too much because most of my clients have investments and they don't get their 1099s till late February anyways, right? And even then we have to hold off on filing them until closer to April 15th in case there are any corrections, right? But there are a lot of people who are very eager to file claim refunds or credits that they're entitled to. And we don't know when they're going to start accepting returns yet. So, or whether that's going to be later than the traditional, third or fourth week of January. So.
And just a general comment, normally we post the recording approximately a week after today.
Yeah, that makes sense. All right, then I will take my leave. Thank you.
Thank you.
Thank you very much. Great presentation.